Everybody talks about how real estate is the surest path to wealth. You hear it everywhere. People saying things like, real estate never fails, or just buy property and you'll be set for life. But here's the harsh truth. Most people who try to get rich with real estate actually end up sabotaging themselves. Not because real estate doesn't work, but because the way they approach it practically guarantees failure. The reality is, there are dozens of ways you can quietly destroy your chances of building wealth in this business without even realizing it. Some mistakes are obvious, like overpaying for a property you can't afford. But others are subtle, like chasing the wrong markets, ignoring cash flow, or falling into the trap of thinking appreciation alone will save you. These aren't just small errors, they're wealth killers. They're the difference between owning a property that builds your future and owning one that slowly bleeds you dry. In this video, we're going to peel back the curtain on the hidden mistakes that quietly ruin people's dreams of getting rich with real estate. And I'm not going to keep it generic or sugar-coated. I'm going to explain them in detail, in plain English, the same way I would if I was sitting down with a friend who's just starting out and needs to hear the raw truth before jumping in. Because if you know what not to do, you'll have a much better chance of doing the things that actually lead to success. So let's break this down, piece by piece, and talk about how people destroy their chances of getting rich with real estate. One of the fastest ways to destroy your chances of getting rich with real estate is to come into it with the wrong mindset. People approach this business like it's a lottery ticket. They think buying one property automatically makes them wealthy. Like the moment they sign the papers, the money will just pour in. That belief alone sets you up for disaster. Because real estate, at its core, is not about instant wins. It's about discipline, strategy, and patience. If you can't see it as a long-term game, you've already started digging your own financial grave. Another way people sabotage themselves is by chasing hype instead of fundamentals. They see headlines about hot markets, they hear stories about investors who struck gold in booming cities, and suddenly they throw their money into overpriced neighborhoods because they're afraid of missing out. But when you chase hype, you're always late to the party. By the time you've heard about a market being the next big thing, prices have already inflated, competition is fierce, and the returns that made it attractive in the first place are gone. You've locked yourself into a property that looks good on paper today, but leaves you stuck tomorrow when the market cools off. Then there's the trap of ignoring cash flow. This one destroys more beginners than almost anything else. They buy properties that look nice, that feel like a dream home, but they don't run the numbers honestly. They assume rent will always be high, that vacancies will never happen, that expenses will stay the same forever. They don't account for maintenance, for property taxes that rise over time, for tenants who miss payments or leave without notice. And when those realities hit, their so-called investment becomes a money pit. Month after month, they're pouring money in just to keep it afloat. And here's the truth. If your property isn't putting money in your pocket consistently, it's not an investment. It's a liability dressed up like one. Financing mistakes are another silent killer. New investors often jump into mortgages they barely understand, thinking if they just qualify, they'll figure it out later. Adjustable rate loans, poor down payment strategies, high interest terms, these things add up fast. The smallest change in interest rates can wipe out your profits if you didn't structure your financing properly. And let's be real, banks don't care about your dreams of wealth. Their job is to make money off your debt. If you don't take financing seriously, you're handing them your profits before you ever see them. But beyond the numbers, ego plays a massive role in destroying people's chances of success. Some folks buy property just to brag about it. They want to say, I own real estate, as if the title itself makes them wealthy. They end up buying flashy properties in expensive areas, over-leveraging themselves, and stretching their finances so thin that one unexpected repair or one tenant vacancy sends them into panic mode. Real wealth in real estate doesn't come from showing off. It comes from boring, steady, consistent properties that quietly put money in your pocket month after month. And let's not forget about the importance of knowledge, or rather the lack of it. People jump into real estate with no education, no mentors, no research, and no understanding of how deals actually work. They trust the wrong people, sometimes even shady agents or sellers, because they're desperate to get started. They skip due diligence, avoid inspections, or don't bother analyzing comps. And by the time they realize the property isn't worth what they paid, it's too late. The contract is signed and the money is gone. Education isn't just a bonus in this game. It's the shield that protects you from being eaten alive. Then there's fear, the opposite side of the ego trap. Some people sabotage themselves not by jumping too fast, but by hesitating too long. They overanalyze every detail, second guess every decision, and wait for the perfect deal that never comes. Meanwhile, opportunities pass them by. They waste years sitting on the sidelines, convinced the timing is never right. And in real estate, waiting forever is just as destructive as rushing blindly. Because wealth isn't built by thinking about investments. It's built by taking action on them, intelligently and consistently. Another way to quietly ruin your chances is by underestimating the grind. Real estate is not as passive as people think. It's not just collecting rent checks while sipping cocktails on the beach. You're managing tenants, dealing with repairs, handling legal issues, navigating property management companies, staying updated on laws and taxes. If you walk into it thinking it's easy, the reality will crush you. The people who get rich with real estate are the ones who respect the grind, who know its work, and who treat it like a real business. The ones who treat it casually get chewed up and spit out by the market. And finally, one of the biggest wealth killers in real estate is the lack of patience. Everyone wants to get rich in a year, maybe two. But real estate is about decades, not months. Properties take time to appreciate. Cash flow builds slowly. Equity stacks up as you pay down loans. Those who quit early because they didn't see overnight results end up walking away right before the real money would have kicked in. That impatience is what keeps people broke. Because in truth, wealth with real estate doesn't belong to the fastest. It belongs to the most consistent. So how do you destroy your chances of getting rich with real estate? You do it by approaching the game with ego, with ignorance, with impatience, or with fear. You do it by chasing hype instead of fundamentals, by ignoring cash flow, by signing onto bad loans, by failing to do your homework. Real estate is a path to wealth, yes, but only for those who play the game the right way. Play it wrong, and not only will you fail to get rich, you'll end up poorer than when you started. One of the most overlooked ways people sabotage their wealth in real estate is by surrounding themselves with the wrong people. Who you listen to matters more than you realize. Too many beginners take advice from friends or relatives who've never owned an investment property, or they fall into online groups filled with people who only talk but never execute. Worse, they sometimes trust contractors who overcharge, property managers who underperform, or lenders who push them into deals that only benefit the bank. Every person you allow into your real estate circle has the power to either save you money or drain it from you. And if you don't build a solid team, if you don't carefully choose who you listen to, you're basically setting fire to your chances of building lasting wealth. Another silent killer is poor record keeping. It sounds boring, but ignoring the details of your finances can ruin everything. Missing receipts, sloppy bookkeeping, or failing to track every expense and every stream of income doesn't just make tax season a nightmare, it costs you money. You lose deductions you could have claimed. You overpay when you don't have to. And you make decisions based on feelings instead of actual numbers. Real estate isn't just about properties. It's about managing money like a surgeon. If you don't know what's coming in and what's going out to the dollar, your investments aren't investments. They're gambling chips. Then there's the danger of overleveraging. Debt can be a powerful tool in real estate, but it's also a double-edged sword. Too many beginners get addicted to leverage, stacking loan after loan, thinking as long as they can buy more properties, they're on the fast track to wealth. But without proper cash flow to back up that debt, the whole thing comes crashing down like a house of cards. One vacancy, one unexpected roof repair, one dip in the market, and suddenly they're juggling payments they can't afford. Instead of building wealth, they've built a fragile empire of debt that collapses under its own weight. Overconfidence can be just as destructive. The first deal goes well. Maybe they catch a lucky break. And suddenly they think they've cracked the code. They start cutting corners on due diligence, stop analyzing numbers with the same discipline, and assume every deal will be as good as their first. That arrogance blinds them to risks, and the market has a brutal way of humbling investors who get cocky too fast. Real estate rewards humility, because humility forces you to double check, to research, to verify. The moment you think you're too smart to fail is usually the moment you set yourself up for your biggest loss. On the flip side, greed ruins just as many investors. Chasing every deal, stretching yourself too thin, trying to grow faster than your knowledge and systems can handle. That's how people implode. They see opportunity everywhere, but they don't stop to ask, do I have the skills, the capital, and the structure to handle this right now? Real estate is full of shiny objects, new markets, different property types, creative financing tricks, But jumping at every single one spreads you thin, dilutes your focus, and destroys your foundation. The investors who actually get rich are the ones who focus, who master one strategy before moving on to the next. And of course, neglect is one of the deadliest mistakes of all. Properties don't take care of themselves. Tenants don't always treat them kindly. Pipes burst, roofs leak, foundations shift. Ignoring maintenance to save a few bucks is like skipping oil changes on your car. You might think you're saving money, but eventually the engine blows and the cost is 10 times higher. Small problems become big problems when neglected. And those big problems don't just drain your wallet. They eat your profits, destroy your equity, and sometimes even wipe out your entire investment. Taxes are another trap people underestimate. Some new investors think if they're making money, they'll just figure taxes out later. But taxes in real estate aren't simple, and ignoring them is financial suicide. Between capital gains, depreciation, recapture, and local property taxes, you can lose a huge chunk of your wealth if you don't plan ahead. The smart investors use tax strategy as a weapon to build wealth. 1,031 exchanges, depreciation schedules, entity structuring. The ones who don't bother to learn, they end up shocked at how much of their profit disappears into government hands. That's not just bad planning. It's a direct hit to your path to financial freedom. And maybe the most tragic way people destroy their chances is by quitting too early. They buy one property, it gets tough, something goes wrong, and instead of adapting, they walk away. They tell themselves real estate doesn't work, when the truth is they didn't give it enough time. They didn't build resilience. Every seasoned investor has scars, bad tenants, unexpected expenses, deals that went sideways. But the ones who make it, the ones who get rich, are the ones who keep going despite the setbacks. Failure in real estate isn't permanent unless you decide to quit. Real estate will test you. It'll expose your weaknesses, magnify your mistakes, and punish your lack of preparation. But the good news is, if you know how people destroy their chances of success, you can avoid making those same mistakes. Every pitfall someone else falls into is a lesson for you to learn from. The real question isn't whether real estate works, it's whether you're willing to respect the game enough not to sabotage yourself. One of the most powerful ways people ruin their wealth-building journey in real estate is by treating it like a side hobby instead of a business. They don't create systems, they don't track metrics, they don't treat tenants like customers, and they don't treat contractors like partners. They dabble. And dabbling in real estate is like dabbling in surgery. You either go all in with precision and seriousness, or you bleed out. The people who get rich treat their portfolio like a company. They plan, they organize, they document, and they think years ahead. The ones who treat it casually, they become the landlords with broken down properties, angry tenants, and constant stress. Lifestyle choices also play a bigger role than most people realize. Too many beginners think real estate is a shortcut to luxury. The moment they get a property cash flowing, they're out financing a new car, booking vacations, or flexing on social media. Instead of reinvesting that cash into more deals or building reserves, they spend it. They treat their first taste of success like a jackpot instead of seed money. And that short-term thinking destroys their long-term wealth. Real estate is supposed to create freedom. But if you inflate your lifestyle faster than your assets grow, you're not free. You're trapped in the same cycle, just with bigger bills. Emotions are another silent saboteur. Some buyers get emotionally attached to properties, convinced they've found the perfect one. That attachment blinds them to red flags. They ignore structural issues. They brush off bad locations. They even justify paying more than it's worth, all because they've fallen in love. Real estate doesn't care about your feelings. The market doesn't care that you had a good vibe when you walked in. Numbers don't lie, and if you ignore them, your wallet will expose you later. On the flip side, fear ruins just as many people. They hesitate to buy. They panic during downturns. They sell at the worst possible times. Fear makes them exit when they should hold, and makes them freeze when they should act. Both greed and fear destroy wealth. They're two sides of the same emotional coin. Another subtle way people sabotage themselves is by ignoring local realities. They look at national headlines and assume the same applies everywhere. But real estate is hyper-local. What works in Texas doesn't necessarily work in New Jersey. A hot rental market in Florida doesn't mean your small town in Ohio will see the same demand. People destroy their chances by not learning their market on a street-by-street level. They miss the trends in zoning, the new employers moving in, the schools gaining or losing reputation. That ignorance means they buy in the wrong neighborhoods, or worse, in places where demand is slowly dying. Real wealth comes from mastering the micro, not following the macro. Another wealth killer is refusing to adapt. Real estate changes, interest rates rise, laws shift, tenant expectations evolve, technology disrupts the way properties are managed and marketed. If you stick to outdated strategies because that's how it's always been done, you get left behind. For example, some landlords refuse to upgrade amenities, thinking tenants should just be grateful for a roof. But in a competitive market, the landlords who adapt, who invest in smart upgrades, energy efficiency, or even better marketing, are the ones who attract stable tenants. Stubbornness isn't strength in real estate. Flexibility is. Networking, or rather the lack of it, is another silent killer. So many people try to go it alone. They don't talk to other investors. They don't attend meetups. They don't build relationships with agents, lenders, or property managers. They think they can figure it all out themselves. But the truth is, wealth in real estate often comes down to who you know. The best deals are rarely on Zillow. They're passed along through relationships. The best contractors are referrals. The best financing terms are found through networks. If you isolate yourself, you're shutting yourself out of opportunities that could accelerate your growth dramatically. And then there's impatience, the lifestyle version. People want success now. They want to buy 5 properties in their first year. They want to live off cash flow instantly. They want to quit their jobs before the foundation is solid. That rush causes reckless decisions. They cut corners, overextend, and skip steps. And when the inevitable problems hit, they don't have the stamina to survive. The irony is, if they slowed down, if they built carefully, they'd actually reach financial freedom faster in the long run. But impatience blinds them, and they crash before they ever take off. Finally, one of the biggest destroyers of wealth is arrogance about timing. People think they can predict the market, that they know exactly when the peak or the bottom is. They sit out waiting for the perfect time to buy, or they buy recklessly because they think the boom will never end. The truth, nobody times the market perfectly. The people who get rich are the ones who buy smart, buy consistently, and hold long enough to let time do the heavy lifting. Trying to outsmart the cycle usually ends in disaster. Either you miss the boat entirely, or you ride it straight into a crash. When you zoom out, you realize most people don't fail in real estate because the market doesn't work. They fail because they get in their own way. They sabotage themselves with bad decisions, lack of discipline, poor planning, and emotional choices. Real estate has built more millionaires than almost anything else, but it's also broken plenty of people who walked into it blind. The path to wealth is there, but if you walk it carelessly, you'll never see the destination.